Question 51. Which of the following is the most accurate representation of the net operating cycle? So we've got days of inventory on hand plus days of sales outstanding, days of sales outstanding minus number of days payables, or days of inventory on hand plus days of sales outstanding minus number of days of payables. So we're looking at three different variables here. So days of inventory on hand, days sales outstanding, and then number of days payable. And then so basically different combinations of these three things. So the net operating cycle is essentially measuring the company's short-term financial health and operational efficiency. And it's measuring that operational efficiency from essentially purchasing inventory and getting all the inventory until the sale, and then receiving money for that sale, and then paying suppliers and all of that. And so our best answer for this is going to be answer C, which is going to include all three of these different variables, since including payables, sales, and inventory is going to give us our full picture of the net operating cycle. Answer C. Question 52. What condition of the fraud triangle would you most likely associate with the following statement? With? I need to exceed investors' expectations to ensure stock prices increase. So we've got incentive, opportunity, or attitude, or rationalization. So looking at C first, attitude or rationalization, this statement would have to include something that was essentially rationalizing the decision to do something. So in those types of instances, you're normally justifying the fraudulent behavior that you're doing because of some greater good or some other purpose that you feel is more ethical, which is allowing you to rationalize doing the unethical thing. So this is a pretty straightforward statement, and I don't think it includes anything related to this piece, so I think we can rule that out. B, opportunity. So for an opportunity to take place, there would need to be some type of oversight in governance or regulation or something like that. So this statement would need to include something where there was lack of governance in the company, so the CFO was able to adjust the numbers or something like that. That's what opportunity would look like. And so then this is going to fall under A, incentive. There's an incentive for them to get for stock prices to increase so that they're exceeding investors' expectations. So they may essentially engage in some fraudulent activity that kind of shows that their stock prices were increasing even though they may not have been, for example. So this one's going to fall under A, incentive. Question 53. Calculate the percentage that will be represented by shareholders' equity on a vertical common size balance sheet based on the information below. So we've got liabilities of the company at $40 million and shareholders' equity at $25 million. So for a vertical common size balance sheet, this is going to be where everything is represented as a percent of total assets. And our total assets will be liabilities plus equity. So for this balance sheet, we're going to be doing everything divided by these two numbers added together, so $65 million. So to do shareholders' equity, here's what that final formula is going to look like. It's going to be 25 million divided by the 25 plus 40, which is 65 million, which gives us 0.3846, which is going to round and be closest to answer A. Question 54. J Limited is a cosmetic manufacturer. An excerpt of its income statement during 2019 is given in the table below. So we've got revenue, cash collected, returns of goods sold, so things brought back after being purchased, and then cost of goods sold. Given that the company uses accrual basis of accounting, the net revenue recognized for the 2019 income statement is closest to. So under accrual accounting, we're going to be recognizing our revenue when it's earned, not when cash is collected. So this cash collected column is going to be just something that's trying to throw us off. It's not going to be relevant for the question. So what is our net revenue that we're going to be recognizing for 2019? don't need to take into account the cash collected. Cost of goods sold is going to be calculated for gross margins, but it's not necessary for net revenue. So that leaves us with two key variables for net revenue. So essentially what we're going to do is we're going to take our revenue, and then we're going to subtract out the goods that we sold that were returned. And so that's going to give us our net revenue number, which is pretty straightforward there. 2 million minus 200,000 gives us 1.8 million, which is going to be answer A for us. Question 55. The auditors were not provided with the supporting documents for the majority of the transactions, including material transactions selected for the audit. Which type of audit opinion should most likely be issued in such case? A, an adverse opinion. So an adverse opinion is likely not going to be issued due to the support documents that were not provided. So in an adverse opinion situation, they would have been given enough of the support documents so in this case, if they were provided the support documents for the transactions, including material transactions, and then those supporting documents led to the auditor thinking that they did not do a good job with their financial reporting, essentially, to put it simply, that's what would lead to an adverse opinion. So in this instance, because we're not provided the documents, they can't necessarily give an opinion good or bad. A qualified opinion. So I think we're also going to be able to rule this out. And the key here is that they are not provided these support documents. They can't really give a qualified opinion if they don't have enough information to do the audit properly. And so that's what's going to lead to us choosing answer C, which is going to be disclaimer of opinion. And disclaimer of opinion is basically saying we can't provide an opinion on these financial statements. We can't say whether they are good or bad because we don't have enough material information to distinguish whether they're good or bad. So we'll go with answer C. Question 56. A company reported the following: net income, non-cash charges, interest expense, CapEx, and tax rate. The company's free cash flow to the firm is closest to. This is a pretty straightforward calculation. We're just going to need to know the formula for free cash flow to the firm, which in this instance will be net income plus non-cash charges. So that'd be something like depreciation or amortization. We're going to add back interest expense and then adjust that for our tax rate. So it's going to be this 25,000 times 1 minus the tax rate, or 0.8. And then we subtract out CapEx and working capital. In this instance, we're only given CapEx. We're not given working capital, so no adjustment needs to be made there. So we end up with 700,000 plus 45, which is these first two numbers here. And then add 25,000 times 0.8, and then subtract out that CapEx, and then no working capital adjust for. Brings us to 746,500. Which is going to be answer C. Question 57. Calculate the inventory value from the following data using the weighted average cost method. The transactions took place in the order mentioned below. So we've got opening stock, so starting inventory, then we bought 5 more units at $6, 3 more units at $5, and then we sold 14 of those. Then we bought 2 more units and then sold 1 more. So what's our ending inventory? I'm going to pull this full sequence in, and we'll walk through everything. So we started with 7 and then we bought 8 more units. So before we sold anything. So for these 14, there's 15 units here. So the weighted average cost for these first 15 units, we're going to take 7 times 7 for the starting number, add 6 times 5 for this purchased number here, and then 5 times 3 for this purchased number here, and then divide that by 15, which is the total number of units, gives us a weighted average cost of 6.2667. I'm going to round that to 6.27 for the rest of this. So then from here, we sold 14 of these. So now we have 1 unit left at that 6.27 cost. So from here, we bought 2 more units at $9 per unit. So from here, we calculate our new weighted average for the remaining 3 units, which is going to be 6.27 times 1, plus 9 times 2 and then divide that by 3. So that weighted average is going to be 8.09. And we have 3 units at 8.09. So we sold one of those units. So we have 2 units left. So our inventory is going to be units left over times the weighted average per unit. So we have 2 left. 8.09 is the cost that we determined. Brings us to 6.18 ending inventory value, which lines up right there with answer B. Question 58. Identify which of the following statements regarding intangible assets are most likely correct. So we've got these 3 different statements here, and then for our answers, we've got statement 3 is correct, or statements 1 and 3 are correct, or all 3 statements are correct. So let's take a look at these statements and determine whether they're correct or not. Statement 1, an intangible asset with a finite life is amortized over its useful life. That is going to be a correct statement. So an intangible asset with a finite life would be something like a patent or copyright. So in the pharmaceutical world, it might be a drug that the company has a patent on, and then at the end of that 5 or 10 year period or whatever it is, it's no longer as much of an asset because then other companies are going to be able to replicate that drug. So that's an example for finite life, and we do amortize it over its useful life. B, an intangible asset with an indefinite life is tested for impairment. That's also going to be correct. And something like this, something with an indefinite life is something that doesn't necessarily expire. So it could be something like a company's brand and the power that they have from having that brand. And while it doesn't necessarily expire, it could become impaired. So it's important to test that for impairment. And then lastly, if an indefinite-lived intangible asset is impaired, the loss is recognized in the income statement. This is also going to be a correct answer or a correct statement. So we're going to want to go with answer C. All 3 of these statements are correct. Question 59. In 2015, a company increased its deferred tax asset by 1.2 million. The company most likely. So before we dig into these answers, let's just remind ourselves what a deferred tax asset is. So essentially, a deferred tax asset occurs when we pay more tax now than we're from a tax return perspective than we're realizing on our income statement currently. So essentially, we're paying more tax now than is on our income statement. So in the future, we're going to be able to use this payment to kind of offset some tax once that income statement money is realized. So let's take a look at these answers. A, became entitled to a 1.2 million tax refund. So tax refund is only going to be applicable if we overpaid our taxes from a permanent standpoint, whereas a deferred tax asset is just kind of a temporary sorry. It's a temporary realization of paying more taxes. Tax refund would be if we permanently had overpaid and we're entitled to receive that money back. The deferred tax asset, we paid more now, but we know we're going to owe more later, so we use that asset to offset that. B, had a lower accounting profit compared to its taxable income. That sounds like what we're looking for. If we realized less income in our accounting profit versus taxable income, then we would have paid more, paid on this higher amount now and had a lower income later. Had a lower income now and we'll have to pay more later, so we use this asset to offset that. C, had permanent differences between accounting profit and taxable income. These types of differences are never necessarily permanent. Tax code is always going to be ever changing, and these types of differences can reverse. So we can rule out C for that answer, and we'll go with answer B. Question 60. The following information has recently been made available about a private company: operating profit margin, net profit margin, total asset turnover, tax burden ratio, financial leverage, and cash conversion cycle. The company's ROE is closest to. So we can use our DuPont analysis to calculate ROE from some of these numbers. So what we're going to pull out of here is net profit margin, and we're going to multiply that by asset turnover, and then multiply that by financial leverage, and that's going to give us our ROE number, which will be 0.15 times 0.95 times 1.4 gives us almost 20%. So our closest answer is going to be B, rounding that up to 20%.